Macy's stock surged an impressive 20% after the retailer reported fiscal second quarter earnings that significantly exceeded Wall Street's forecasts, sparking renewed investor confidence. But here's where it gets controversial. Despite previous concerns about tariffs and economic uncertainty, Macy's not only beat expectations, but also raised its full-year earnings and sales outlook, signaling a stronger-than-anticipated recovery. The department store giant announced that its revamped stores have played a crucial role in improving sales trends, helping the company regain momentum in a challenging retail environment. Macy's now projects adjusted earnings per share between $1.70 and $2.05, up from the earlier forecast of $1.60 to $2. Similarly, revenue guidance was lifted to a range of $21.15 billion to $21.45 billion, compared to the previous estimate of $21 billion to $21.4 billion. This positive update sent Macy's shares soaring, closing 20% higher on Wednesday. Just last quarter, Macy's had trimmed its full-year guidance amid worries about the impact of President Donald Trump's tariffs on consumer goods. The company had expressed uncertainty about how these tariffs might affect sales. However, CEO Tony Spring shared a more optimistic view in a recent CNBC interview, emphasizing that Macy's is well-positioned to capture market share, enhance customer experiences, and adapt to the current retail landscape. Spring acknowledged the reality of tariffs, noting that while they are a tangible challenge, Macy's is actively working to counterbalance these headwinds with several tailwinds. These include offering a better shopping experience, refreshing product assortments to reduce overlap, and growing business across all three of its key brands, Macy's, Bloomingdale's, and Bluemercury. He also highlighted that the company is entering the fall season with a healthy inventory, which is critical for meeting consumer demand. Interestingly, Spring pointed out that consumers remain resilient, continuing to spend on new fashion items despite economic pressures. Macy's reported its best comparable sales growth in 3 years, driven by strategic focus on high-performing segments such as denim, women's contemporary apparel, and watches. This targeted approach seems to be paying off, helping the retailer maintain its upward trajectory. To put the quarter's performance into perspective, Macy's reported adjusted earnings per share of 41 cents, more than double the 18 cents analysts had expected. Revenue came in at $4.81 billion, slightly above the anticipated $4.76 billion. However, net income for the quarter was $87 million or 31 cents per share, down from $150 million or 53 cents per share in the same period last year. Net sales also declined slightly from $4.94 billion to $4.81 billion year over year, reflecting ongoing challenges in the retail sector. A key part of Macy's strategy involves focusing on a select group of 125 stores that have received increased staffing and renovations. These stores outperformed the broader Macy's brand, achieving comparable sales growth of 1.1% on an owned basis. Meanwhile, Bloomingdale's and Bluemercury, two other brands under the Macy's umbrella, continued to outperform, with comparable sales growth of 3.6% and 1.2% respectively. Another bright spot was a $28 million increase in credit card net revenue, which rose to $153 million. This suggests that Macy's is successfully leveraging its financial services to boost profitability. The strength of a department store or marketplace really shows when multiple categories are performing well, Spring explained, underscoring the importance of a diversified product mix. On the financial front, CFO Tom Edwards revealed during an analyst call that Macy's is considering additional price increases on certain products to offset tariff-related costs. However, he emphasized that these price adjustments will be targeted and carefully managed in collaboration with partners to stay competitive. "We're making price changes where appropriate, not across the board," Edwards said. "Given our business model, I believe Macy's is well equipped to navigate these challenging times." This raises an intriguing question. As Macy's leans into price hikes to combat tariffs, how will consumers respond? Will shoppers accept higher prices in exchange for improved store experiences and curated assortments? Or will this strategy risk alienating price-sensitive customers? And what does this mean for the broader retail industry facing similar tariff pressures? We invite you to share your thoughts. Do you agree with Macy's approach, or do you see potential pitfalls ahead?